Yeah, so for Jedi options, we're going to look at trading a breakout and doing an aggressive directional trade, which sounds foreign coming out of my mouth because I rarely talk about aggressive directional trades. But I'm feeling froggy this morning because the market's green and it's been a while. I also love the chart. I also love the chart. So, what do you do when you find a bullish pattern? This, in this case, it's a bullish breakout, and you have fundamental underpinnings. You have the wind at your back, right? From a fundamental perspective, to Matt's earlier point, they're like solar stocks right now. It's kind of on its own planet compared to the rest of the market. So listen, if you're going to go for strength, I like the chart. It's triggering today. I would call today a trigger bar. It's a massive bullish candle. You want to wait longer? Fine, wait longer, but you can't really deny that the price has is the only pivot I think, or the only wick we haven't taken out is the initial one. I'm discounting that wick for two reasons. This is a little technical analysis lesson. The first reason I discount this wick is because we only touched that level once. Okay, we only touched that level once. Look at the other resistance that you touched 1, 2, 3, 4, 5, 6 times. The market is telling you something about which level is more reflective of, or a better indication of where resistance is. It's the one that you hit 6 times and couldn't get above. It's not the one that you hit once and then came down and didn't hit again. The second reason I would discount this wick is because it was on earnings. And you tend to get massive moves on earnings because in the morning, you had probably a massive imbalance of buy and sell orders. And so the price shoots up, right? And then it came back down. So an outlier is what the wick was. So based on that, I think today's a trigger. Okay. I don't know what more you're waiting for if you're going to trade this breakout with a quick trigger. So I like the trigger. So listen, usually I'm like a sell the out of the money put, sell a bull put, get a high probability. And if I'm going to go directional, I don't usually YOLO 3-day call options. Usually it's a 1 to 2 month bull call spread, nice low cost, not a lot of risk. It's aggressive, but it's not crazy aggressive. Well, today I'm going to go crazy aggressive. So if you want to dial up the aggressiveness on a directional trade, you're going to build a position with a more aggressive strategy, and B, a shorter time frame. Okay. So if you're turning the dial all the way up to max aggressive, you shorten the time frame. We're not going to use 6-month options here. We're going to use maybe a 1-week option. And then you do a strategy like a long call, or maybe even a bull call that is more aggressive, right? So I'm doing a short term, either long call or bull call. We're gonna build both and see what we think on CSIQ. Okay. When I do an aggressive directional trade like this, I would usually size it so I'm willing to risk what I paid. That way I don't have to worry about a stop loss. I can let it play out the next week without worrying about getting shaken out of the trade. I want the flexibility of being able to do that. So I go to the trade tab, and I'll tell you, when I was prepping for this, initially my bias came through, and I'm like, let's go look at building in October, 44-day bull call spread, and it looks pretty good. But if we ran up in the next couple of days, the ROI was maybe 50% or 30% or something. And I'm like, yeah, it's not going to cut it for my poster child of this particular example. So I gotta amplify the leverage a little bit. So I said, why don't I do a 9-day option? 2 days, you're just insane. Okay. I mean, I want to have some prudence here. So I'm going to go 9 days. I'm going to go 9 days. And I'm going to look at a call option. Now, if you buy an in the money call, it's not as leveraged. If you buy an at the money or out of the money call, you're going to have a little more leverage. Cheaper cost, higher ROI is what that translates to. So listen, if I was just going to buy a call, I kind of like the idea of buying the 47 strike. It's right at the money. $1.70 is actually not crazy. It's not crazy. The stock essentially would have to go up $1.70 to get to your break even in 9 days. I'm not asking much, CSIQ. I'm not asking for the moon. I'm asking you to go up $1.70 in 9 days. Your ATR right now is $3.17. I'm asking you to go up less than 1 ATR in 9 trading sessions. I feel like that volatility, what I'm paying for that call, isn't crazy. It would be crazy if the at the money call is $5. Man, you're asking for a lot. $1.70 is actually not too bad. So if I'm going to talk myself into buying a call, having a situation where the call costs less than 1 ATR, and that's the average daily range in one day, I'm paying less than 1 day's average movement for 9 days of time. I don't know. That doesn't seem crazy to me. I think in the next 9 days, it could move up less than 1 ATR. And that is all I need to offset the time decay that I'm going to suffer over the next 9 days, right? Because the counter argument is, well, Tyler, time decay, he's going to eat your lunch for the next 9 days. You're buying an at the money 9-day option. That option is the most sensitive to time decay. Go look at the theta, right? That theta, negative 10.5, negative 10.6, like these two have the highest rate of time decay. Yeah, I know. But all I have to do is see less than 1 ATR movement up in 9 days, and I've gained enough in intrinsic value in the call option to offset all the extrinsic value. That's all we're trying to do when you're buying options. You're trying to get enough movement in the right direction to gain enough intrinsic value to offset whatever you lose in extrinsic value due to time decay. So I kind of like that long call. So if I say, all right, I want to buy this call $1.85, let's right click and analyze this for a second. The beauty of the long call is that you've got the open-ended upside. Okay. And so if solar stocks continue to rip for a few days and really go crazy, I've got a lot of upside here. Realistically, I mean, you can really delude yourself into thinking you're going to make 1,000% return if CSIQ gets to $80, but ain't going to happen in 9 days. All right. But I don't know. Let's say it gets to 50, 53. I don't think 53 is insane. In fact, I think that's just 2 to 3 ATRs. It gets to 53. I'm up $440. I paid 185. It's a pretty good return. That's a pretty good return. So I like 9-day at the money call on a nice bullish breakout where I'm paying less than 1 ATR. Less than 1 ATR. Now, if I don't want the $185 of risk, then yeah, you're going to have to put in a stop loss or use a different strategy. So here's choice number 2. Choice number 2 is to say, let's offset the cost of the 47 call by selling an out of the money call against it. Now, I'm not going to buy the 47 call and sell a 40, come on, son, and sell a 49 call. It's like, listen, you can't set this up as I'm so aggressive. I want to swing for the fence, and then I'm going to do a $2 wide bull call spread. Okay, those are not in harmony, my friend. A $2 bull call is not swinging for the fence. I got to make sure this is wide enough to where I make a decent amount of money before I cap the game, and $2 is not enough. So I'm going to buy the 47 call. I'm at least going out to 50, if not 51, which is about a 20 delta. So let's say I sell the 51 strike, okay, against the 47. I cut the cost from $1.85 to $1.35. So I cut the cost by 50 cents, which is about a third. Cut the cost by about a third. Maybe it's easier for me to risk $135 and $185. So now I don't need a stop loss. Check that box. Have I killed the leverage by selling that higher strike call? Have I killed the leverage? Because I don't want to do that. I'm feeling froggy here, as Mark would say. Well, listen, if it goes up to that 53, you're up $180 today, and at expiration, you're up $265. So $265 is your maximum gain. You see it down here in blue. I only paid $1.35. If I can make $265 on $1.35, it's almost a 200% return. So I think that's big enough. I think that's big enough over a year. The fantastic thing about this is my time frame's 9 days, right? So that's kind of the other piece to this that makes it such an aggressive play is I'm not asking you to wait 44 days until October expiration to make the 196%. I'll give it to you in 9 days because you used a 9-day option. So you shorten that time frame, and that's really what amplifies the leverage. Okay, so for me, I kind of like that 47.51 structure, buck 35. I don't care that I'm capping the gain because it's 200%. I've never complained in my life about a 200% return in 9 days. Good enough. And I think 50.51 is not a pipe dream. I know it's 9 days away. I know that doesn't give you a ton of time. But quite honestly, all you got to do is see 2 more days like you saw today, and you're there. Right. And you're there. And quite honestly, even if it doesn't get all the way up to 51, even if it gets to 50, I'm doubling my money at expiration. Even if it gets to 49 and a half, I'm doubling my money at expiration. So 51's gravy. You get me to 49, 50, and you're making a good return. And I just think it matches. I think it matches the bias. I could be wrong. I could be wrong. That's always the case. But I feel like I've done an appropriate job here of picking the right time frame, the right strategy, given my bias and what I think is possible over the next 9 days for CSIQ.